When you don't have money to feed your family tomorrow, your income is going to be your number one concern.
Another record high for coronavirus infections.
And that obviously means hardship.
Gig workers are suffering.
These are gig economy workers. These are hustlers. These are people who are piecing together different parts of income to make the ends meet for themselves and their family.
Very difficult for us to find work.
Lack of a social safety net.
We had a study of gig workers across 5 countries.
5 countries. In a world that's seen politics and economies overturned, the gig economy, such an economic lifeline, such a short time ago, today dropping workers into insecurity and debt. Blue-collar gig workers.
I am so behind on rent.
From ride-sharing to delivery to home services, once expected to add up to $2.7 trillion in GDP by 2025. Surveyed over recent months, a comprehensive new study measuring global impacts on gig workers' lives and their remarkable resilience.
And the mission for Flourish is to help vulnerable populations.
We felt it was important to understand how they were being impacted, and equally importantly, how we collectively can help them navigate what is a very difficult situation.
Flourish Ventures, a $500 million fintech venture capital firm with global outreach, partnered with local firms to survey 3,000 gig workers across 5 countries affected by the global pandemic. Called The Digital Hustle, Gig Workers' Financial Lives Under Pressure. The study shows gig workers struggling to cope with COVID economic shock.
Across the board, workers' biggest concern was their ability to earn a living. But a close second to that in many countries was this concern about health risks. And I think the two are very closely intertwined. When you don't have money to feed your family tomorrow, your income is going to be your number one concern.
On average, 66% of respondents across all countries reported major income loss. In India, a staggering 81% saw a collapse in take-home pay. Most report reducing consumption like food. They survive on savings and borrowing and finding whatever work they can.
It was total lockdown for the first 2.5 months. In that context, many of them had already seen a steep decline in their incomes, and their ability to survive actually was under question.
Nearly half of Indian gig workers said they couldn't last more than a month without borrowing from friends or family. For 1 in 5, less than a week. Findings that are echoed across the study. In the U.S., 37% said they couldn't last even a week without borrowing. Indonesia and South Africa, similar findings. The problem even more urgent in Brazil.
More than 40% of Brazilians have expressed a lack of hope, so having no sources of hope throughout this crisis. That is compared to, at least in the early days, the global average around 16%.
Across the board, the study found similarities and disparities. Similar concern over cutting back on food and essentials. Savings buttressing workers significantly in India and South Africa, lower in Brazil and the United States. Surprisingly few women responded to the survey, both underrepresented in this study and in the gig workforce itself.
In India, for example, we noticed that the few women who were part of the gig economy got hit somewhat harder, and they also ended up with a higher degree of taking care and being responsible for extended family.
South Africa saw only 5% of women represented in the study.
What really hit home for us was how close to the edge so many of these people are living.
People are cutting consumption. They're not taking hot showers. They are dipping into savings. They are building new skills.
Cutting expenses, not paying off debt.
And here in South Africa, while the lockdown was on, very few workers were able to find other jobs. Not because they didn't try, not because they didn't hustle, but because those opportunities were so low.
In Indonesia, the highest number of respondents last March made over $200 a month. Just a few months later, that crashed. 4 out of 5 now bringing home $0 to $70. Household service workers hit hardest, and still they adapt.
I think there is this emphasis on reskilling and readapting, and that is a great demonstration of the grit and resilience that we are seeing in Indonesia.
One small lifeline in the form of government aid in Brazil, India, and the U.S. For those who got it, it brought hope for now.
And I'd imagine that if we were to survey again these cities, that it would be only greater dire need of these types of assistance and interventions, in part because whatever savings and that was taken advantage of, particularly with stimulus, has since run out. And that's a really tough place to be.
And tougher still for African American and Latinx communities in the United States. More than 60% now earning less than $1,000 a month, and the process to get unemployment benefits has been confusing.
And frankly, we're at risk of trailing the rest of the world, right? When we look at India, where we're with the push of a button, the government was able to send money to vulnerable individuals more quickly than here in the U.S. I think that's something we want to take inspiration from and think about how can it be replicated.
Where can inspiration be found? In the way workers pivot.
In Brazil, we saw that 45% of digital gig workers were seeking additional work, either by joining e-hailing platforms or delivery platforms, supplementing their income or gaining a new source of income by upskilling themselves, starting their own business.
Worker goals include learning new skills, finding new, better-paying jobs, saving for the future, paying off debt. The question begs, how do policymakers, entrepreneurs, and investors team up to help them reach those goals?
I think it's also very important that the government itself is able to engage in the modernization of their own infrastructure so that we can see those benefits in real time and target the consumers who need it.
There's a whole cadre of entrepreneurs who are building solutions, financial services primarily, to these gig workers and accessing them through these platforms. Hopefully this inspires a little more innovation from that class of entrepreneurs.
There might be insurance innovations around income protection, health insurance. So there is a whole host of things that fintech can do as one enabler in what obviously is a much bigger and much more complex situation.
The study was conducted over several months beginning this past spring. It has generated significant news media attention across the globe with over 135 articles and numerous interviews on broadcast networks. Hello, everyone. My name is John Duncanson, and I'll be moderating today's panel. With me are Emmeline Shaw, Tillman Urbeck, and Arjun Acosta, all managing partners and co-founders of Flourish Ventures. I want to take a moment today to welcome my three co-panelists here, but also to invite folks joining us to ask questions. And to do that, you can check out the bottom of your screen for the Q&A or the chat section, and feel free to fire away. I want to talk about this study first. It's projected that half of the U.S. working population by 2023 will be doing some form of gig work. Now, Flourish surveyed what some would call blue-collar gig workers, those relying on platforms that generate calls or jobs. Em, I want to talk to you a little bit about what the genesis is here. Why, as a global fintech investor, did Flourish conduct this survey in the first place?
Thanks, John. Look, Flourish's overall mission is focused on helping people advance financial health and economic resilience, be they consumers, SMEs, or even the self-employed. Over the last several years, we've actually been investing quite a bit across gig platforms globally, in the US and in emerging markets. It's pretty clear the market is growing at exponential rates, and that base is incredibly important, that population globally. For us, it's really about being proximate to the customer. And we saw this research as an opportunity to really understand how was the gig worker faring? How are they faring, particularly during COVID? And we also saw this opportunity to take the research reports and findings and share it out more broadly so that we can discuss and identify not just the challenges, but the opportunities.
And this was a worldwide study. In the US, just specifically, many workers are doing gig work, and it's mainly to supplement income. Arjuna, you found that gig workers, for example, in India, were actually making a good living before COVID hit. These were real jobs for them, stepping stones to something better. That's not so much the case in the US.
Yeah, John. If we look at the emerging markets, they're characterized by a high degree of informality. And the rise of these gig platforms has actually brought some formality to the jobs people were doing. For instance, you drive by any big city in the emerging markets, and you'll find, waiting under a tree, a number of people who could offer services, just tradesmen who could deliver a package for you, who could fix your leaky faucet. What these platforms have done is start to bring them into the formal economy. While not quite the security of a 9-to-5 job with a steady paycheck, this has certainly been a stepping stone, as you put it. Let's talk about what it's really done. It's really created the sense of discoverability, right? Rather than go and find that tradesperson to fix your faucet, there's now a platform that looks a lot like a way to discover that plumber. So both from a customer's perspective, a consumer of the service, and the service provider, there's now a way to match each other. That leads to a sense of predictability, right? As long as there's an equilibrium between customers and service providers, there's some predictable source of income, which at the end of the day brings more stability to people who are living sort of paycheck to paycheck, but not just a predictable paycheck, but highly volatile cash flows. And most importantly, as you point out, this did have a positive impact on incomes. In India, for example, based on the people we surveyed, the gig platform workers were making a full 40% more than the GDP per capita in the country. And this was before COVID hit. Over 60% of Brazilians reported making at least $5,000 a year, which is a good income. And one last thing that these platforms have done is by digitizing the connection to these service providers, it's opened up a whole new channel for those who are building products and services to reach them and serve them.
So it's a win-win for both the worker. They don't have to sit outside the road with a sign, and for the customer in a lot of developing markets and in the US, because you know where to go immediately. Let's take that a little further, Tillman. What's going on behind the numbers here? We've read that the US is trailing emerging countries in several of the categories that you surveyed. India, for example, able to push a button and send aid to gig workers, while here in the US, they're still sending paper checks. It's not just India. Are there other emerging economies leapfrogging the US and how they serve the gig worker population? And is that a trend we're going to see moving toward the future, COVID or no?
There are probably two dimensions to the role of government here. And by the way, that goes beyond the gig economy, come to think of it. The first dimension is, were governments able to provide relief pay as the crisis hit? And in our sample, 3 of the 5 countries actually did do that: the US, Brazil, India. In our sample, in our survey, some 3/4 of the US survey actually really received the government stimulus check. In Brazil and India, it was about half. And those folks were better off. They showed greater resilience. They were more hopeful. So the ability for government to step up made a difference in our survey. The second aspect, and that's what you're alluding to, is around how was that aid, that relief, the stimulus being distributed. And India indeed was able to reach tens of millions of people at the margin of economy, more vulnerable population segments. India was able to reach them with relief checks, or relief payments, I should say, to be precise, with a click of a button in a very short time frame. And India could do that because over the last decade, it had built a modern public digital infrastructure that allows to identify people, that connects everybody. And so you could, with a click of a button, actually reach them. A number of other emerging markets had similar relief efforts, but they didn't quite have the infrastructure. And frankly, they wished they had made the India-type investments. And in the US, the story is not so rosy. The attempt, Congress actually acted very quickly. Then executing relief aid in the CARES Act was not easy. And the fact that we don't have the same type of modern infrastructure showed. So it took between 3 weeks to 3 months to send out these checks. There are still people waiting for them. I just saw the number, a couple million. And we sent them to people who shouldn't have gotten them. We sent them to people who had, frankly, passed away in the meantime. So the US has a lot of work to do when it comes to this notion of a modern public digital infrastructure.
Well, so you mentioned India, the US, and to a lesser extent, Brazil, all providing some form of economic aid to their gig worker population. And according to the study, that translated to a lower level of stress. Now, all that said, government aid in the US, at least for now, has dried up. Are we worse off than, say, in July in terms of hope, in terms of how people are living or planning to live? And you touched on this a little bit in the video.
Yes, I think it's a difficult time. I mean, according to a recent research report by the Center of Poverty and Social Policy that was done by Columbia University, when you look at the work through the CARES checks, through the CARES Act, the stimulus checks and the unemployment, it was actually quite impactful. It was able to lift 18 million Americans out of poverty back in April. What we've seen since then is it's gone down to 4 million in August and September. And that's once the 600 of supplemental unemployment went away, and that had some severe impacts. As you look at the poverty percentages overall, we were at about 15% in February and have grown to just under 17% in September. And that's even with the stimulus activity. And when we look at kind of the Bureau of Labor Statistics and we think about what is long-term unemployment, so over about 27 weeks for Americans, we're at 2.4 million in September. And that's an all-time high during the coronavirus. And if you look at actually Americans that have been unemployed between 15 and 26 weeks, we're talking about 5 million. So we're in a tough spot with a lot of uncertainty ahead, and it's only getting worse.
I think there's also a question here in regard to the study is how much local culture plays into differences and similarities. Tillman, the US is a credit-based culture. So many gig workers in the US couldn't survive a week without borrowing. Yet in India, which we tend to see as a developing economy and high levels of unemployment, that's a savings culture. Tell us about what you found with regard to that, those differences and disparities.
Culture is one aspect of savings behavior. And equally importantly, maybe more importantly, is the notion of the structure of the economy, the degree of informality that Arjuna spoke about earlier. And the reality is, and that might seem counterintuitive to some, people in low-income countries tend to save more of their smaller income. They save a higher percentage. And they have to do that because their income is very unpredictable. And they typically don't have the type of social safety net that characterizes more advanced economies. There's no health insurance, for example, so people have to pay out of pocket when there is a health crisis. So you do have these higher savings rates. And in our sample, that is true as well. India, indeed, and Indonesia have higher savings rate. The US is relatively at the bottom. And as a result, we could, in our data again, we actually saw that Indian gig economy workers, even though they were hardest hit in terms of relative decline of income, they were actually the most resilient across our 5-country sample. So more than half of them said that they could survive at least a month without borrowing. And the reason why was that more than 80% of them had a savings cushion that allowed them to do so. But I mean, what's really important, of course, is these are all relative observations. Gig economy workers across the world have obviously been hit hard by the pandemic and the subsequent lockdowns. And that's why we did this work, to understand how we can help them better.
A quick follow-up to that. I mean, could this be in part, look, in the US, relatively speaking, we haven't seen huge economic dislocation. Maybe we're seeing it now, but up to this point we haven't, where a lot of these developing economies, that's almost a cycle. It could be a 3-year cycle where you go boom and bust. Do you think that there is something to do with that, that saving for a rainy day is such that they know that rainy day for sure is coming, a lot more than maybe Americans who say, well, we'll get through this somehow. We've never really had a big boom.
That's the psychology of relatively high savings rates in emerging markets and in developing countries. This is really contrary to often belief, right? In lower income households in emerging markets have less discretionary spending income. That is absolutely true. But they do save a disproportionate portion. And it is for the reasons that you are mentioning. They have to. They need to build a fund for the rainy day. They need to save up for bigger type of expenditures because they don't have the type of financial services that we all take for granted, right? We get our income or we get our paycheck on the 1st of the month, and then we pay our mortgage or our rent on the 5th of the month. So our cash flow spikes are nicely aligned, and we have insurance coverage if something happens. If you are economically active in the informal economy of an emerging market, you have none of that. And frankly, life is tough to begin with, and the lack of access to these type of instruments makes it even more hard. It is expensive to be poor. And that's partly why we are working on the formalization of financial services. And that's why we pushed, as Arjuna and Em said earlier, the formalization via, this is an emerging markets perspective, the formalization via gig economy platforms, because that brings people closer to a steady income and greater resilience.
And we want to get to that in terms of what fintech can bring to this situation in terms of solutions, and we'll do that in a minute. One thing that this study shows is that worldwide, people actually want to work. They want to be productive. Arjuna, you found that even if they can get assistance in the 3 countries that we talked about, in many cases, they weren't just looking for handouts.
That's very true, John. And I think here, the name of the report, The Digital Hustle, the deliberate choice of the word hustle is very telling. These are people, as I said, again, taking an emerging markets perspective and that level of informality. These are people who've been forced to hustle to make ends meet. They've been part of an informal workforce, often sort of creating a patchwork of jobs and living close to the edge, right? So while these gig platforms brought some stability to their lives, as discussed, the pandemic, in a way, has surfaced that inherent entrepreneurialism, right? That hustle mentality all over again. A staggering 61% of Indonesians that we surveyed and 45% of Brazilians have found new and additional work. We're all familiar, particularly in the US where I live, right? The pivot from ride-hailing to delivery, right? The Uber driver who's now an Uber Eats delivery person. But what we're seeing is beyond that. It's the ride-hailing driver who's now a one-person mobile catering business, or a one-person grocery store on the move, right? That kind of ability to be entrepreneurial, to figure out where the seams in the economy are and find another way to supplement your income is quite remarkable. Now, mind you, this is not everyone. Not everyone has a soft landing, as we played in the video and highlighted in the report. People are struggling to make ends meet. People are cutting consumption. It's it's really heartbreaking to read stories of people cutting back on food, which is so essential. But the takeaway I think I'd like to leave people with is that there's remarkable resilience and optimism. And these adverse times, the pandemic has brought that back up to the surface. In the short term, everybody's worried about how to keep themselves and their families safe and healthy while continuing to earn a living, right? But when we asked folks how they think about their financial futures, the number one financial goal across all the countries we surveyed was to save for the future, to have that financial cushion, to build that financial cushion to allow their children to dream big, right? And for them to be able to back those big dreams. They keep coming back to that. So there's always this sense of looking forward, looking to the next generation, looking to the future to see how they can build a better future for themselves and their children. And that resilience and that sort of underlying sense of hope and optimism in the future is really remarkable and something worth focusing on.
Interesting, the pivot. And one of the things we heard in the video was that we need to kind of redefine how we see gig workers. In doing this study, are you challenging established notions, particularly in the US, that gig workers are only young and part-time? Uber says that 24% of drivers are over the age of 50. Let's talk about the takeaways that point us away from those preconceived notions.
Yeah, I think it's a very common misconception, actually, that the gig workers, particularly in the U.S., are Gen X or millennials. But actually, maybe let's take a step back for a moment and look at some of the more macro statistics around U.S. According to Gallup.org, about 36% of Americans, so roughly 56 million, actually identify as participating in non-traditional work, and that could be gig and hourly and 1099. Among that, actually 43 million actually have identified that type of work as creating a full-time job. So they're creating a portfolio of opportunities. Now, just keep in mind for context, 70% of US Americans today are living paycheck to paycheck. The income volatility is incredibly high. This opportunity to augment income, to use more flexible work opportunities to augment, to kind of create a smoothing mechanism is essential. And it's a critical part, actually, of what's driven a lot of the adoption within gig workers. Interestingly, actually, about our traditional notion of the gig platforms, so, the Ubers and Lyfts, DoorDash, et cetera, only represent about 10% of that activity. So there's a broad array of what we characterize as kind of gig work available to Americans today. When you look at the Gig Economy Data Hub, which is kind of a collaborative between the Aspen Institute's Future of Work and Cornell's industrial and labor relations work, they actually did a study specifically on the demographics of the gig work community. They found about 27% fall between the ages of 16 to 25, 23% between 35 and 45, between 26 and 35, 23% between 35 and 45, and 34% actually over the age of 46 years old. So it just gives you a sense, over a third or over 46 in age. And you just get a sense of the breadth and depth of what this gig worker base is like, and what types of services that need to be addressed given the breadth of the demographic.
Arjuna, you talk about studying the gig work experience, so to be better equipped to provide solutions by fintech, such as insurance or credit or other banking services. Tell us what that means on a ground floor level about how workers actually evaluate and use whatever platforms and services that entrepreneurs have come up with or could come up with in the future.
And I think trust, for financial services, trust is a key, right? Other than credit, where your service provider is giving you money on the assumption that you'll pay back in the future, most financial services require the customer to hand over hard-earned money on the promise of the service provider doing something in the future. To put money into a savings account is trust that it'll be there when I want it in the future. To pay my insurance premium this month today presupposes the belief that I will get the payout when something goes wrong again in the future, right? So how do you build that bond of trust to allow for a holistic array of financial services to be provided. Now, if the service is provided and delivered by the same platform through which I make my livelihood, I'm much more likely to trust the service that they provide or they curate for me. So the platform doesn't have to be the provider necessarily, but could be just the curator, right? But it gives me that channel to access financial services. So this trusted channel, we think, has tremendous potential to make finance and money what I call intuitive and invisible. So let me paint a picture here. Imagine that for every dollar I make as a ride-hailing driver, a penny is automatically deducted and put into an account that pays for the taxes that are due at the end of the quarter. The next penny pays for the life insurance premium that I've purchased a policy for me and my family. Similarly, money gets automatically deducted and put into a college savings account for my kids. It helps me pay off a credit card that's specially designed for me to be able to maintain my car, put fuel in my car, make sure that that asset of mine is always working for me. Savings for a rainy day, check. Money to send to a relative back home in my village, check, right? All of a sudden, money becomes invisible. I'm not sitting there and wasting valuable mental bandwidth trying to make all this happen. I can actually automate this, make it invisible to me. So this is money working for that aspirer, that striver, without consuming mental bandwidth. That's powerful. And that's not that far off. And I don't think that's that far-fetched. So I think what we're seeing today is first, the formalization, as I talked about in the emerging markets, then the growth of these platforms to scale, the level of trust that's been built, the leveraging of that channel, and now the innovation that's coming on top of this to solve all of these financial problems that I just talked about. Now that gets us at Flourish, excited about looking for those new innovations, looking for the entrepreneurs that are pushing the envelope and taking a very customer-centric view of the problems and creating financial solutions for them.
I find that, in the course of the interviews that we've done, that word trust kept coming up, and you just put it into great perspective. You have to get the workers to buy into those platforms and then trust the fact that the money that's taken out is going to go to the right place. And I mean, that's what we're talking about, right? That these workers have to buy into this whole whatever platform that exists.
Absolutely.
Yeah. The New York Times this week had an article about how working women in the U.S. are facing an undue burden caused by the pandemic. 4.5 million fewer women were employed in October than a year ago. The Times article says that this could have lasting impact on women in the U.S. workforce. Tillman, how do you think this plays out globally? Will women who were underrepresented in the entire gig economy, will they get a better foothold in the global economy, or is COVID really a huge setback?
So what COVID is doing and the economic lockdowns are doing, they're really changing the structure of our economy, how we live, how we work, how we shop. I mean, look at us. We are doing this virtually. We would have normally been together on a panel. So there are, without any doubt, dramatic changes in the underlying structure of our economy. And when there's a vaccine and when we can all travel again, some of that will reverse, but many things will not reverse. And that does impact everybody. When it comes to the gender dimension, women, the macro data, and you just quoted the New York Times for the US, the macro data seems to suggest that there's a disproportionate impact right now. In our own survey, in the 5 countries, as you already alluded to, frankly, the first big finding with respect to gender was that women are massively underrepresented in the gig economy as we sampled it In the emerging markets, it was different for the US, but in the emerging markets, dramatically underrepresented. And then when we looked at the impact that COVID and the shutdowns had across our survey samples, we didn't find, statistically speaking, very strong gender-related insights. In India, we did see that women had a slightly sharper or higher, even higher decline in income, but you saw in the summary statistics, it was 80% to begin with for everybody. We also saw in India, and this is cultural to some degree, we also saw in India that women took on in our sample survey, did take on a disproportionate share of household work and took care of more dependents. So that's obviously unfair, right? You are hit to begin with harder, and then you have to bear a higher burden. And I wouldn't be surprised if US data is similar to that. This is in the short term. In the long term, I think it's too early to tell. And I could actually imagine that some of these things will unfold differently from what you might expect. So listen, the notion to work from home, working more flexible hours, having easier on-ramp, off-ramps when it comes to big life events like maternity, the structural changes that are dramatically accelerated right now might actually help women in certain professions, segments of our economy. Too hard to tell for me at this juncture. Maybe Em has a perspective for the US, actually.
Yeah, interesting. So talk about a little bit about Flourish's decision to start investing in gig workers to begin with. Arjuna, I mean, were you ahead of the curve? And I guess the second part of that question is, are investors around the world on pace now with these kinds of investments?
Yeah, John. So I'd say more generally, we were early in investing in startup tech companies that were delivering financial services to the mass market, right? Historically, banking penetration across the emerging markets was very low. Banks were seen as the privilege of what often people will call the doctors and the engineers, so the upper classes. And that was true because of the economics of banking. It was hard to build a beautiful glass-fronted bank branch and serve the mass market who were making, small transactions, frequent transactions that didn't make a lot of money for the bank. I think going back over a decade, we started investing in the potential of reaching people with a simple feature phone, pre the ubiquity of the Android and iOS devices that are in people's pockets now, really in a 2G world. And I think some of those early investments we made helped move the market forward, and move the market forward in a couple of important ways. I think, first of all, I'd like to think we helped prove the potential for fintech in general across the demographic spectrum to build sustainable, profitable businesses and impactful businesses that reach these mass market populations with products and services. And as this wave of digital platforms that have become indispensable to our everyday lives to start to think about themselves as financial service providers, I think some of the early investments we made have proven that. Let's take an example, right? You can no longer be just an e-commerce company. You have to think of yourself as an e-commerce company, but a company that allows your customer the option to buy now and pay later in installments. Increasingly, every checkout experience has that as an option. That takes you out of the realm of pure e-commerce and into the realm of financial services. You're now a credit provider. Now, you might not, as the e-commerce company, be the direct provider of credit. You may be partnering with somebody, and we've got investments in that space. Zest in India, for example, that partners with e-commerce companies and travel agents and the like to allow you to purchase now and pay later. But that's embedding finance into a very different transaction. And that's just the tip. what these companies are doing is they're leveraging their core asset, a digital channel to the customer, and that trusted relationship and a strong customer base to start to bring financial services more broadly to the populations. When we are more specific about the gig platforms, to your question, John, what the gig platforms have done is they've become a marketplace with two equally strong sides, right? They've got a strong and loyal customer base that's digitally connected to them and that's transacting frequently with them. And then they've got the loyal worker base. And they're starting to figure out how to deliver financial services to both sides of the platform. As I said earlier, if you are in the flow of cash to your workers and you have that trust, you can start to think really creatively about how to embed financial services into the platform. And on the customer side, if I'm a frequent user, the platform now has a lot of rich data on my usage patterns. Can they use that as an edge to start to bring me better services? Of course, we've got to keep in mind that there are restrictions around data privacy and data usage. And I think across the globe, we're seeing both private sector and the government start to think more about that. And customer voices are important to be heard in this debate as well. But once we solve some of those challenges, I think we will continue to see both investments from Flourish, but also from others in the ecosystem that are now highly sensitized to the potential of mass market financial services, of digital financial services, and of leveraging these platforms to embed vital products that customers need and use.
And as you and I
Hey,
talked
Arjun,
at one point, oh, I'm sorry, go ahead, Em.
Sorry, Em, you had a
no, I
point?
just wanted to jump in a bit as it relates to the US. I mean, what we're seeing is there's obviously these behemoth platforms that are serving the gig worker in different capacities. But as I mentioned earlier, about 43 million have identified their full-time job as being a portfolio of this type of work. And so what we're finding is a real need for a platform to aggregate those opportunities to optimize for the highest income level at any particular geography, to be able to stitch that work together that suits their needs. And then ideally supplement with some really rich financial services on the back end, most of which aren't currently being provided to the gig worker today. So, insurance and retirement and healthcare and the like. And those are things that are really important as you think about how do you embed and how do you aggregate that base and then how do you provide rich services. Steady, being one of our companies in the US, has been kind of well positioned for that. But we think about that as a broader need, particularly as we look at the US trends.
I think that's a great point. If I can just jump in, John.
Go.
I
No,
think
please.
as Em talked about this portfolio of work and this patchwork of jobs, right? It gives us an opportunity to think about not just financial services, which is in some ways optimizing the money you're already making, but how do we help people make more money? How do we help people be more creative about generating more income? Because that, at the end of the day, will drop right down to the bottom line. And that's when we really start to see less of this financial vulnerability, less of the uncertainty around cash flows, and more predictable, stable income. And that ultimately should be our goal.
Well,
Exactly.
Arjuna, you touched on something. Tillman, did you want to say something? I'm sorry.
No, I'm good.
Okay. You touched on something right there that is interesting to me, and that is when I see Flourish, it seems that your approach to investing is not first from the standpoint of where's the opportunity, but rather from where's the need. And you seem to look for a need, then look for tools that someone can develop, and that's then where you invest. Em, is that a secret sauce in your DNA? And where does this take Flourish as a venture firm?
Yeah, look, I think we're very maniacally focused on technology innovation that advances either directly or indirectly financial health and economic resilience. And so against that backdrop, we absolutely look for innovations that we can see, maybe their initial wedge solution is addressing a specific need that then kind of argue towards advancing financial health. But I would say that actually, in and of itself, if that were to succeed on its own as a platform, it probably isn't sufficient. And let me just expand that further. So it's not that they are just commercial return, large scale market leaders. Our goal as an investment fund and as a fund who looks for impactful outcomes is to see that have a longer term sector impact. And so let me give you an example of a sector that we've been looking at and we've started to see the tipping point against, and that's under challenger banks. So about 3.5 years ago, we saw this trend towards the unbundling of banking services. And it was very clear to us that if you could truly unbundle, as Arjun had mentioned, the banking services, you could actually provide a very rich suite of services for the entire population up and down, irrespective of their income levels, and really to provide a no fee, low fee type of solution, and then ultimately add, incredible financial services that advance financial health over time. And we started that thesis off, and we looked early in the U.S. and Chime Bank was one of our many investments, and we actually now have 9 global challenger banks around the world. And as you can imagine, as many of us know, the sector has taken off. There's been a lot of incredible innovation, many great successes. But if you look at Chime for a moment, right, they are one of the preeminent leaders. They have over 8 million users, just incredible retention rate, incredibly high savings rates, which again kind of go to the advancement of financial health, unit economics profitable, and its most recent valuation of over $14.5 billion, I think they've clearly grown and really shown a market dominance. But the reality is many companies have come out of this. Many companies globally, including our broader portfolio, have all really benefited from that innovation and that growth. And I think as importantly, you're actually seeing financial services and incumbents respond. You're seeing them recognize there is a need. And these folks, they serve billions of consumers worldwide. So they recognize the need to say, well, we need to really think about our own digital services. We need to rethink about our fee structures. How can we do it differently? And so you're starting to see a tipping point. And it will take some time for sure. But it's that evolution, it's that portfolio that then provides a broader shift that's really powerful. And that's how we view our investment strategy. And then I would say we augment with really important work, including the research work we do today, like the gig worker work. It's a very good example of thought leadership. How do we raise issues more broadly? How to identify opportunities and risks? And then on the other side, we actually invest very heavily on the ecosystem. We recognize that in a regulated industry, you really need to kind of partner closely aligned with policymakers and regulators, and that's another very important part of our process.
Well, let's go to that policy work. Tillman,
John, if
how
I
do you
could
move
just-
toward?
Yeah,
Please
Sorry,
go ahead.
can I jump in quickly? Em talked about the focus on sort of technology solutions. I want to give you the other side of it, which is an equally maniacal focus on the consumer, right? What are their daily lives like? What are their challenges? What are their needs? What are their demands, right? Because if you can put together the technology solution with the actual demand and you tailor it to the needs of the customer, that's where I think the magic happens. And this digital hustle research is an example of that. I think if you would take me back a year ago, I would have loved to be in the field in Brazil or Indonesia or India, actually talking to these workers, right? I don't think I've ever been in an Uber car in any market in the world without asking them what phone they use, what bank they use, and how they use it. In this new COVID-driven world, this digital hustle research really helped us keep close to the ground, keep close to the voice of the customer, so that we can start to sort of be that bridge between entrepreneurial, technology-driven solutions and really where the pain points are.
And I want
Sorry,
basically,
I cut you off for asking a question, I think.
That sounded as if, John, you wanted to ask about the regulatory work. And I'm happy to talk to that in a second. But let me add 2 comments on what Arjuna and Em both said. One is you framed this notion of we put need first, less opportunity. And we actually don't think that there's a contradiction or a tension between those 2 things, right? So if you identify a deep customer, consumer, small business need, and if you can serve that in better, cheaper, more adequate ways, than has been done traditionally, you have a big opportunity. So no trade-off between being focused maniacally, as Arjun and M said, on the end user and making them better off and having a big commercial opportunity. That's the first comment. And then the second comment is our focus on technology-led innovation is that's a means to an end. What technology allows us to do today as a broader community, it allows to do things that were previously simply not feasible, right? So M spoke about a bank that is essentially just an app, and it uses the rest of the infrastructure. It doesn't have a branch. It doesn't have legacy IT systems. And when you do that, you can provide a much better service so much more cheaply that it is a win-win proposition for everybody. And the same is true on the credit or insurance side. And COVID actually, and the lockdown and these structural changes in the economy that we talked about earlier have accelerated all these type of trends. So we are in this almost ironic situation that at least makes me at times feel somewhat guilty and humble, but our portfolio, which was betting already on tech, remote, online only, no physical infrastructure, our portfolio is doing really, really well, because things that we thought would take 5 or 10 years to happen from a changing in behavior perspective have massively accelerated in the span of just a few months.
So COVID is an accelerator, right? At the end of the day.
Yeah.
Well, I think M mentioned it, or Arjun, I'm sorry that I can't remember, but we're talking about policy work. Let's go there now. I mean, how do you move toward streamlining the regulations in the financial industry, which could, really amount to headwinds? And how do you get to tools being embedded into platforms that can protect workers so they can weather that next big shock? I mean, there's a discussion, I think, going into the future where there might be, many beneficial ways for policymakers to smooth the way so that services can be delivered to those who need it quickly. Is that a fair assumption? And will it happen?
It is. And let me start by saying that we very much believe that the financial sector needs to be well regulated and supervised. You guys spoke about trust earlier as one of the key ingredients of a financial system. We need people to believe in paper money. So we cannot undermine trust in the system. So we have a lot of sympathy for regulators, policymakers and regulators, as they balance the 4 big objectives of any financial system, which is stability, inclusion, integrity. We don't want the system to be abused for nefarious things like trafficking in drugs or money laundering. And we need consumer protection as well. So policymaking, regulation of a financial system is absolutely necessary. What's happening a bit, and this is more true in advanced economies, because we have all these structural changes, different people now could provide financial services, or at least could be the front end for financial services. The platforms that we are talking about are one of them. And a lot of the traditional regulatory measures or thinking that is in place around what does it take, for example, for you to open an account, right? You have to show an ID and an electricity bill in this country. Or how do you look for suspicious activities? A lot of the thinking and the policy making and the regulation around these things in many countries predates the invention of the iPhone, right? The regulators with good intent didn't even conceive of the world that we are now living in. And so we do need an updating, actually a continuous updating on our approaches to these things. Because there are probably better ways to identify whether people should get access to the financial system. I gotta believe that in today's world, right, with machine learning and data availabilities, there are better ways to find suspicious activities rather than going through reams of papers with a yellow highlighter. And that is what is still happening in a lot of countries. So yes, we do need this acceleration, and it will happen. And we do two things against that. We do invest in B2B fintech companies, or RegTech companies as they are called, who are providing some of these modern services, digitally native, cloud-based. And of course, they can only do what the regulators allow them to do. But these companies do exist, and they are accelerating the modernization of the system. And we invest against that. And then the second thing we do is, with many others, we are engaging in a policy and regulatory dialogue globally in specific countries. In the US, the transition team of the president-elect is actually on the record to look into some of these things that could accelerate real-time payments or retail payments in the US that could make funds more immediately available. Because a lot of what's happening today is this notion of, I have a check, or I get my paycheck on Friday, but my bank only is going to credit me on Monday. And if I need funds over the weekend, what do I have to do? I have to cash my check for a steep fee. And these are the type of inefficiencies that have accumulated over the years, decades. And we can do much better than that.
Well, you mentioned it, Tillman. I mean, this thing right here is what has changed a lot of this, probably more in the developing world. And I'm getting this from conversations with you all that we've had prior, but whereas the U.S. is tied to an infrastructure that was built out in the 50s to begin with, these countries didn't have that infrastructure, so they were able to leapfrog immediately to cell phones and go digital immediately, so they can uptake. But with regard to regulation, how then do you change an entrenched system? Is that through direct conversations, as you mentioned, possibly with the Biden administration, or is that a more soft kind of envelopment, as something like we're doing right now, or through marketing or education to say, hey, this is the road we're traveling, it's a new road, and you really have to realize that the old road is been chopped up and we're paving forward?
So first, I say the entire system has to learn together, right? Regulators want to do the right thing. And they have these competing objectives that I mentioned earlier. And so they are appropriately careful. So learning has to happen, evidence has to be created. So for example, we helped a non-for-profit organization in the US to stand up and to research how some of these innovations that we are talking about might impact people. And it's called the FinReg Lab. The first study that they did was around the use of these new data sources, often generated because we all use the cell phone, etc. The use of these new data sources for credit underwriting. And there were 4 consumer credit companies who participated and 2 small business lenders. And what the study found, and the regulators were invited to watch this process, if you will, what the study found was that the use of this alternative data expands access to credit. That's good news. And very importantly, it does not lead to some type of discrimination through the back door, which we, from a policy perspective, would not be comfortable with. We don't want data to be used to discriminate against people on the basis of gender, race, or other characteristics. So you have to create an evidence base, you have to create dialogue, you have to create consensus. And that does take time, but things do move in the right direction. And the crisis in the US has shown how outdated the system is and has really created an opportunity for consensus-based action that we didn't think was maybe possible just a year ago. So we are actually quite optimistic on this front.
Interesting. I want to take a minute now to take a few questions coming in from a number of the folks who are viewing this discussion. I'll read this. This is great research and shows that people know how to deal with risk and being flexible. Regulators have a big voice in the ability to work flexibly and within the insurance industry to manage risk. They actually slow innovation. How can we get regulators to understand that flexibility and distribution is not a bad thing? And I think it goes to what we were just talking to, so it kind of dovetails. And
Yeah,
any one of you can jump in
I'd
on
be
that.
curious to hear Arjuna's and M's perspective. I do reiterate that regulators have very legitimate concerns. Not everything that is technically feasible is necessarily a good thing to happen. And they need to balance the new opportunities that the tech-led change in our economy and in the underlying services. They need to balance the new opportunities with these new risks. And the risks include data privacy, data security, new forms of exclusion and discrimination. So I personally have a great degree of sympathy, and it's work that needs to be done. Arjuna, what's your perspective on this one?
And
For the
maybe
US,
I'll jump in.
Oh,
Sorry,
please.
go ahead. One quick perspective, and John, we talk so much about this lean startup approach, right? How do you test and learn? What's surprising is that regulators are starting to adopt that approach. They're calling it sandboxes. So create a little space, a little safe space in a sandbox, if you will, and allow for innovation to be tested. And the regulator stays very close to this, and they're learning, and they're rapidly iterating, right? So I would say that yes, while they're worried about safety and soundness of the system, they're showing a lot of sort of progress in adopting new methods of doing things. And I think this is only going to accelerate.
I think to expand a bit on Tillman's comments earlier, it's absolutely true that they have a lot to contend with. And I think the intentions are very good. And we want to make sure that we're aligning with those. We want to recognize they're looking out for their consumer first and foremost. In the US, what we've done, in addition to FinReg Lab, is another entity called AIR that is actually run by Joanne Barefoot, who's a former US regulator. And it was really important for us to back this effort, particularly because their focus is exactly that. How do we bring all of these stakeholders for whom, honestly, this technology is happening so quickly, the application of which is unknown, and how do we create these environments so that, to Arjuna's point, we can start to experiment, and experiment as simple as what type of technology can we actually use in our day-to-day as regulators? How does that shift our own workflow? How do we benefit from those? And then how do we think as it extends to broader fintech plays? And what are the implications? And I think to have that dialogue with folks across party lines, across states, to really ask those questions are really important. And that's what AIR has done a great job in doing. And her focus, having been a former US regulator, I think has made a huge difference in creating that trust and that cohesiveness. And it's the beginning. And I think we need to replicate and see more of that happening. And certainly we are one of many that can help promote this. And so we encourage others to jump on board. But it's having that conversation and being willing to understand the technology. I think that's half the battle.
Is part of that conversation having those regulators attend conferences, attend discussions like this one, making sure that they actually see what's happening on the ground around them and not, in a cubicle where they're studying things rather esoterically?
That's actually exactly what AIR has done in a pretty meaningful way, in a very thoughtful way, across a number of different dimensions, many of sectors of which Tillman made reference to. And yes, you're right, that needs to continue to happen, these types of convenings.
Okay.
John,
another question. Go ahead, please. I'm sorry.
No, in the emerging markets, what we found is really powerful is a forum for regulators to learn from each other. So there's a peer group called the Alliance for Financial Inclusion, which is about 100 central banks from the global south. And we support them with grant funding because it's a powerful mechanism. Rather than being told by outside experts, learning from your peers of what's working in one country and how it may be adopted to another country actually is a really effective way for them to adopt new ways of doing things.
Okay, so we have a study, and it's quite extensive, and it's gotten a lot of media attention. People are very, very interested in it. The question is, where do we go from here? What are the key takeaways for gig workers, entrepreneurs, et cetera? So you have all this data. You might have touched on it a little bit, but go into it a little deeper. Where does this take us?
I can start and I
John,
go.
you want to start? Yeah.
Yeah, I can start and I go back to some of the observations that Arjuna M and I made earlier. The pandemic and the lockdowns are changing our economy. It impacts people differently. There will be different ways of working, earning a living. And by learning, by observing, by listening, we need to evolve with those changes on the ground. And we have invested in the past in platforms that help people make more money, platforms that help them optimize across different gigs, embedded credit, as we mentioned earlier, to provide working capital, embedded insurance to protect from earnings risk. All of these things we were doing already. And now the underlying economy is changing. So we will do similar things, but differently. And we need to double down, because ultimately what we want to do is to help people, right, live a better life and increase their financial health and capture economic opportunity. So to me, it's an important input into the bigger picture of a journey that we were already on, and that has been accelerated by the events of the last 8-9 months.
And you yourselves have had to pivot, even in doing this study.
Yeah. Go ahead, Ed.
Yeah, look, I would just say, as we think particularly about the U.S., as I noted earlier, the gig worker, that population is only growing at exponential rates. And we need to think about what those needs look like. And they're different than a W-2, right? They don't have benefits. They don't have health care. They don't have retirement. And how do you think about the portability of those essential items as you think about long-term viability and resilience is going to be really important. And you've begun to see a little bit of innovation there, but I think we're so early in terms of what we can really give at scale for this space. And it's, some solutions as simple as taxes. Taxes are different for the 1099. And quite frankly, if you're doing it across 10 different platforms, it's even more complex. And so just the level of complexity that these folks are contending with, and the types of budgeting and services on the back end as they actually start to grow their own livelihood, I think is going to be really important. So in my mind, at least from an entrepreneurial perspective, there are a lot of greenfield opportunities that I think, if really thought strategically and intentionally, can build some pretty meaningful services to address this space that are very commercial in nature and very important in terms of impact.
Okay, last chance. Anybody want to cover something that we haven't talked about yet?
Well, I think in the what next question, we did this research first because we wanted to be proximate to the voice of the customer, right? And since we couldn't travel, this was a way to surface what's actually happening in people's everyday lives. But I think to what Em said, what next? We hope that this inspires innovators, entrepreneurs out there, as well as the big platform owners, to say, hey, you know what? There's this underlying insecurity in people's financial lives. And we have the trust, we have the platforms. How do we think about tailoring products, building new services to serve this population? And if a couple of ideas come out of this, we'd love to back them, but more importantly, we'd love to see them take hold and scale and impact people's lives.
Make social change. That is very commendable, very admirable. Love what you guys are doing. We want to thank everybody today for joining us on a topic clearly of growing importance and dire need. It is a conversation that's so important as the number of gig workers across the world continues to grow. I do want to say that anyone else who has questions, please reach out to the flourish.com website and ask those questions, reach out and join the conversation. Thanks to Emmeline Shaw, Tilman Urbeck, and I'll go to Arjuna Costa. I knew you wanted a quick word at the end here.
Thanks, John. First, just to appreciate your thoughtful facilitation. So thank you for shepherding this conversation this morning. And before we sign off, I wanted to thank the entrepreneurs and partners in each of the countries that we worked in. We worked with startups who are busy, innovating on product, and they are in the middle of tech sprints and new product launches, but gave us the time and resources to open up their customer bases and help us get this research done. So really appreciate that. And of course, I'd be remiss if I didn't add a special thanks to the over 3,000 gig workers across the world for taking the time to share with us both their challenges and their hopes for a better tomorrow. Right, their resilience and their optimism really should be an inspiration to us all. I know it's what gets me up in the morning, excited to sit at my dining room table. You can't see it, but that's where I'm at right now, and to work all day. So a real appreciation to all of those gig workers out there who aspire and strive for a better tomorrow.
Okay. Arjuna, thank you very much. And I want to fall on my sword here. It's flourishventures.com. If you do have questions, go ahead onto the website. We'll be having blog posts regarding some of the questions that you have that were not answered. So there's a lot of information. Please feel free to reach out and engage us. Again, thank you very much. Have a great day and have a great rest of the week. I'm John Duncanson.
Thank you.
It's not enough to just be an investor. You need to think about the broader ecosystem.
We like to think of ourselves as hard-headed but soft-hearted investors.
We believe that by bringing all of these facets together, you can actually work towards building a fairer, more just, equitable financial system.
And we believe that tech-led innovation can be a force for good.
We really want to solve this for the long term, and that's such a privilege that we have at Flourish Ventures.